Let's now bring in our halftime headliner, which is BMO Capital Markets' Brian Belski. Brian, I had already alluded to the fact that we were on a panel together earlier this morning.
We were. It was riveting.
It was riveting. You, Gabriela Santos, Emily Rowland. It was. I thought it was riveting. I loved being a part of it. As we welcome you in, we hit a lot of themes today, and one of them was whether or not we are in bubble territory and whether the bubble is bursting. You don't think it is. Tell us why.
I don't think it is. By the way, thanks a lot for having us. And this has just been an amazingly humble time being here and seeing all these great people. And it's been an amazing. But so let me answer your question. To have a bubble, in my view, it's not a bubble just because asset prices go up. It's a bubble if everybody's making money. And I don't believe everyone's making money. Here's the two best examples. And I've lived through two bubbles. One was the tech wreck, and the second was the great financial crisis. In both times, everybody made money, meaning the investment bankers, and the sector that was leading the way was the asset price that everybody thought was a bubble. In tech, we had superstar analysts, superstar bankers, all the financial people, the investment banks were making tons of money, IPOs, secondaries, and it was crazy. And so we got way over our skis. Same thing happened in the financial crisis. Now, again, in 2007, nobody made more money on Wall Street than they made in 2007, including myself. Haven't even gotten close to that high water mark. And I think because of that, just because assets go up doesn't mean that we're in a bubble. Now, if we're in a bubble, individual things like crypto or individual stocks, that's different. But I think in market sense, people love to make these broad calls that the market's on a bubble. I just don't think it is until everybody is losing, everybody's making money and making really, really bad decisions.
All right, so we also talked about this idea, and Josh and Joe alluded to it earlier. B of A fund manager surveys, low points right now.
Yeah.
Consumer sentiment measures at really low points right now. There is a lot of negative, soft data, survey-type data that says people just aren't feeling good about what the outlook is. In times like that in the past, it has been a contrarian-type indicator. Do you feel that way now?
It has, and I had the good fortune of working for Merrill Lynch for a long time, and we kind of used it as that, actually, even internally, number one. Number two, on the consumer sentiment stuff, remember, I'll remind everybody, the low water mark for consumer sentiment previously was November of 2022. This new bull market started in October of 2022, a month before that ultimate low in consumer sentiment. So again, some of these macro data points, they're not all contrarian, Dom, but you can use it that way, and that's the way we kind of look at it. Lastly, just in terms of everyone's worried about earnings going down and everything, actually when earnings revisions wash out, that actually also is another contrarian positive. So we have not changed any of our models. We maintain our 6,700 target, and we think the bull market is alive.
Joe T., are you buying what Brian is selling?
Well, I think the big question, Brian, is growth is down. S&P growth is down nearly 9% year to date. S&P value is only down 1%.
Yeah.
That indicates a dramatic paradigm shift for investors. Yep. Respond to that if you could. How would you think about that?
2 points. Number one, as you know, the way that S&P puts the growth and value together is it's a farce, right? Because you have stocks in both categories.
Correct.
Okay, that's number one. Number two, it kind of follows through with our broader theme. We were just a little early on it. Last year, our theme was the Jackie Moon theme. I mean, everybody love everybody. I think you have to own a little bit of everything. And I think that's the market we're going into. And we've talked for years now that we're entering into normalization. What's normalization? It's not normal to have 7 stocks lead the way. It's not normal to have 0% interest rates. It's not normal for a lot of this concentrated momentum type performance, not just the Mag 7, but these individual themes. Think about Lilly, for instance, right? And so what I think is going to end up happening is own a little bit of everything. And the growth and value indices and the small cap and the dividend growth stuff that Josh and I have talked about for a long time back and forth. I think all of these things kind of fit together. It's not just all tech. It's not just all S&P 500. It's a little bit of everything, and I think that's really going to benefit investors.
What about you, Bill? I just want to Bill, because do you think, as a commodities-related guy, as an RIA now, do you think that Brian's points are valid?
I think they're very valid, and I like the sentiment indicator. We're seeing the bearishness, I mean, at historic levels, as great financial crisis levels. That alone is not a buy, but you look at put-call ratios, those are at buy levels. I like the idea of owning value, but I don't think this is the time in which you're going to need to chase value. You want to be. I think this is time to buy tech.
All right, BMO Capital Markets, Brian Belski, thank you very much. And it was great seeing you at the panel this morning, too, as well.
Thanks.
All right.